7 brokerage accounts you should close immediately and where to move your money. Wealth Simplified. 10-minute script, 1,400 words. The average American investor is quietly losing between $50,000 and $200,000 over their lifetime. Not from bad stock picks, not from market crashes, but from fees they don't even know they're paying. Right now, there's a very real chance that the brokerage account you opened 3, 5, maybe 10 years ago is slowly draining your wealth every single month, and nobody is going to call you to tell you about it. In the next 10 minutes, I'm going to show you the 7 types of brokerage accounts you should seriously consider closing, the specific red flags that tell you it's time to leave, and exactly where to move your money so it actually works for you. Stick around, because number 4 on this list is one that catches almost everyone off guard, including people who consider themselves financially savvy. By the end of this video, you'll know how to spot a wealth-draining brokerage account before it does any more damage, and you'll have a clear, actionable plan for where to move your money instead. This is for educational purposes only, not financial advice, but it is based on real numbers that will make your jaw drop. Let's start with the one most people have and almost nobody talks about. If you opened a brokerage account through your regular bank, we're talking places like Wells Fargo Advisors, Chase's investment arm, or Bank of America's Merrill Edge guided investing tier, there's a strong chance you're paying commission fees and fund expense ratios that are 2 to 3 times higher than what's available elsewhere. Here's a real example. A managed portfolio at a traditional bank brokerage often carries an advisory fee of around 0.85% to 1.25% per year. That sounds tiny, but on a $100,000 portfolio, that's $850 to $1,250 gone every single year, whether the market goes up or down. Compare that to Fidelity or Vanguard, where total expense ratios on index funds can be as low as 0.3%. Over 30 years, that fee difference on a $100,000 starting investment compounds into over $180,000 in lost wealth. That's not a rounding error. That's a retirement. Where to move it? Fidelity, Schwab, or Vanguard. All 3 offer zero-commission trades and index funds with rock-bottom fees. Robo-advisors were a brilliant innovation. Automated investing, diversified portfolios, no human advisor needed. But not all robo-advisors are created equal. Some of the earlier and more premium robo-advisors charge 0.25% to 0.89% annually, just for the automation layer, on top of the underlying fund fees. Betterment's premium tier, for example, charges 4%. Wealthfront is tougher. Those aren't catastrophic. But here's the thing. If you have a relatively simple investment strategy, you are paying for automation you could replicate yourself in about 20 minutes. If your robo-advisor portfolio is essentially just 3 or 4 broad index funds, you could move that exact allocation to Fidelity and pay almost nothing. Where to move it? Fidelity Go is actually free for accounts under $25,000. Or go fully self-directed and buy a simple 3-fund portfolio yourself. This one is emotionally the hardest to leave because you have a relationship with a human being who seems to genuinely care about your future. And maybe they do. But caring about you and being the most cost-efficient option for you are 2 very different things. Full-service brokerages, your Edward Jones, Ameriprise, Raymond James of the world, often charge a 1% assets under management fee plus fund expenses. On a $250,000 portfolio, you could be paying $3,500 or more per year in combined fees. Here's a question worth asking. Is your advisor consistently beating a simple S&P 500 index fund after fees? Decades of data say most don't. In fact, over a 15-year period, roughly 92% of actively managed large-cap funds underperform the S&P 500 index, according to S&P's own SPIVA report. Where to move it? If you want human guidance, look into fee-only fiduciary advisors who charge a flat annual fee or hourly rate, not a percentage of your assets. Then house your investments at Schwab or Fidelity. I told you this one would surprise you. If you have money sitting on a centralized crypto exchange, Coinbase, Kraken, Gemini, that you're not actively trading, that is not a brokerage account, and it is not a savings account. It is an unsecured liability on a private company's balance sheet. After what happened with FTX in 2022, where over 1 million customers lost access to their funds overnight, this should be non-negotiable. Exchanges are not FDIC insured. They are not SIPC insured. If the exchange goes under, your money could be gone. This isn't anti-crypto. If you believe in digital assets, own them, but in a hardware wallet you control, or through regulated investment vehicles like a Bitcoin ETF inside a brokerage account that has real investor protections. Where to move it? A regulated brokerage with SIPC protection for your traditional investments. If you want crypto exposure with protections, consider Bitcoin ETF options available through major brokerages. Raise your hand. If you have an old 401k at a company you haven't worked at in years, almost everyone does. And here's why that's a problem. Old 401k plans often have limited fund selection and higher expense ratios than what you'd get in an IRA. The average 401k expense ratio is around 0.45%, but many older plans sit at 0.80% to over 1%. You also have less control, less visibility, and some plans will actually charge you small account maintenance fees if your balance dips below a threshold. Where to move it? Roll it directly into a traditional IRA at Fidelity or Schwab. It's a tax-free transfer. It takes about 2 to 4 weeks, and you immediately unlock a universe of lower-cost funds. Do a direct rollover, meaning the check goes straight to the new institution, so you don't accidentally trigger taxes. Commission-free trading sounds amazing until you understand payment for order flow. Platforms like Robinhood built their model on selling your trade orders to market makers, which can result in you getting slightly worse prices on every single trade. For a long-term buy-and-hold investor, this matters less. But if you're actively trading, those fractional cent differences per share add up. More importantly, several of these apps are engineered with gamification features, the confetti, the streaks, the push notifications, that are literally designed to get you to trade more frequently, which historically destroys long-term returns. Where to move it? Fidelity or Schwab offer commission-free trades without the gamification and with significantly better customer service and research tools. This last one isn't about a specific platform, it's about an account you opened without a goal. Maybe it was a brokerage account you funded once, bought one stock on a whim, and haven't touched since. No plan, no strategy, just money floating in the void. An account without a purpose is an account that won't perform. You don't need 17 accounts. You need 2 to 4 accounts with clear jobs. A tax-advantaged retirement account like a Roth IRA or 401k, a taxable brokerage for medium-term goals, an emergency fund in a high-yield savings account, and maybe a 529 if you have kids. Consolidate. Simplify. Every account you have should have a specific job description. Where to move it. Consolidate into your primary brokerage. Fidelity and Schwab both make it seamless to hold multiple account types under one login. Here's your action item for this week. Pull up every financial account you have, look at the fee structure, and ask yourself, does this account have a clear purpose, and is it costing me more than 0.25% per year in combined fees? If the answer to either question is no, you know what to do. If this video saved you from a costly mistake, hit subscribe. We publish new videos every week, breaking down the financial decisions that actually move the needle for people building real wealth in their 20s, 30s, and 40s. And we put together a completely free wealth blueprint PDF that maps out exactly how to structure your accounts, what to invest in, and in what order, based on where you are financially right now. You can grab that for free at wealthsimplified.com/free guide. The link is in the description. Last question I want to leave you with, and I genuinely want to hear your answer in the comments. What's the worst financial account you've ever had, and what did it cost you before you finally closed it? Drop it below. You might just save someone else from making the same mistake. End of script. Script stats. 1004 10 words. 10 minutes at average speaking pace.